I agree with George. Our presentations will be fairly aligned. I'm calling this overall presentation, Do You Have Enough Inflation Protection? And that's because not many people are investing in value. And I really want to highlight a quote from a well-regarded financial historian, Russell Napier from Ireland. And he wrote the book called An Anatomy of the Bear Market. So he really understands, the historical bull and bear markets, and he gives a lot of examples of what the media was saying in advance and post the peak, and how there's so many mixed messages in the media at the time. You'll get the growth people talking and the value people talking, and it's hard as an observer to see the truth while you're in the middle of it. And he highlights in particular a stagflationary period, 65 to 82. And he says that the only asset class that preserved wealth for investors was value investing. And I found that a very compelling statement to lead off my presentation overall. So first of all, I want to highlight, and we've talked a little bit about this earlier today, is how lonely value managers feel today. And this event today has been just so delightful to myself because there's been so much talk about value in a very positive way. These are true believers standing up here on the stage. But most investment events today are very growth oriented, and that's very very typical. Human beings want to win the game of investing. And when I was drawn into investing earlier in my career, I was really drawn to the fact that investing isn't just about fundamentals. Yes, in the long run, stocks will migrate to their fundamental value. But we waver from it a lot. And why we waver from it is human emotions. And human emotions have a huge impact on valuation, particularly in speculative manias. And I would argue that we're in one of the three great speculative manias this past century. And so we're experiencing it right now with a lot of these hot new stocks coming into the marketplace. And the disinflationary period, we've just gone through recently 40 years of disinflation, a very lengthy period. So almost all of us know how to invest in a disinflationary environment. That's what we've experienced almost all of our investment careers. But we've only had an inflationary experience the last 5 years. Now, I've been working since '83, and I missed the big inflationary period. So even myself, I haven't truly operated in an inflationary environment. But the last 10 years of that disinflationary environment, we got to record low interest rates. And in that period, growth became explosively valued because the denominator, as interest rates got smaller, the future value of cash flows grew dramatically. So obviously investors flooded into the growth style and stepped away from the value style. And you're seeing here the movement away from value, and it's still at dramatic lows. The allocation of value around the world appears to be about 6% today. So I call it the mother of all contrarian trades. Value managers tend to be contrarian. There's very little money in value. The average value shop out there today, if you ask them what their AUM is, it's less than half of their peak. And as Alex pointed out, we're a bit less because we're more deep value. We didn't migrate into quality at all. But it's been getting better, and I'm going to explain that to you. So this is the famous Fama French value versus growth data series. And how you read this is looking at the Shiller PE multiple. So the black line is showing you the 10-year relative return of the market. And when the black line is above zero, so that upper mountain there, that is value outperforming growth. And when you see the valleys below the zero line, that is growth outperforming value. So the first takeaway you get from looking at this chart is that most of the time, value investing wins the game. So it's really interesting that almost no one is investing in value today. The allocation is 6%. And the other interesting observation I want to make is that if you take a look from 1941-42 all the way to 98-99, there's a 54-year period where in every 10-year time horizon, value style outperformed the growth style. So there wasn't quality managers back then. They called themselves GARP, growth at a reasonable price, because no one would buy growth because for 54 years it didn't outperform. And so you had to add a little bit of, growth to, value to your growth style. Today, value managers have been underperforming for a long time. So what have they been doing? A lot of them have migrated into quality. They're adding a little bit of growth in order to keep up with the market overall. And a lot of former GARP managers became quality managers overall. Now, to understand this chart better, I added vertical lines. And so you don't normally see this in a FAMA French data series. And I think that the way to understand what's going on in the marketplace, it's very additive to know whether you're in an inflationary environment or a disinflationary market environment. And they tend to be lengthy periods. So are you in a falling interest rate environment or in a rising interest rate environment? And I think this picture comes into focus a little bit more. So although we see 80% of the time value outperforms, we see that there's this barbell effect where growth outperforms, on the two ends. And what's going on there? Why those two ends? Why did growth win then? And those were disinflationary periods, and not just disinflationary, but deep disinflationary periods, relatively speaking. And that's when growth has its chance to outperform. And each dot on that line represents a 10-year time horizon. And so we had, I'm going to call the low in rates, happened in the summer of 2020. And from that moment on, we hit the lows and we entered an inflationary environment. And my question to the audience is, how long do you suppose an inflationary environment is likely to last? And for a lot of observers, you hear people thinking that we're going to go back to a growth environment. They're actually wishful of it overall. So I'll come back to that, answering that question a little bit further along. So now that we're in an inflationary environment, how does value do in an inflationary environment? And Professor George Athanasakis in Canada took the famous FAMA French data series over a century. It's a century now. The first data series is 1926. And he said, how did value do versus growth when inflation was north of just 2.5%. And he chose that number because basically developed nations around the world are saying, we're going to inflation target 2%. We're going to try and keep inflation at 2%. So if they slip just a little bit, how might value do? And what he concluded in the end was that in that century of data, that value outperformed growth by 11% annualized when inflation was moderate overall. Pushing the wrong button, I guess. Did I break the thing? Anyone?
Maybe the battery is empty.
Can I go? Oh, maybe I can do it myself.
Exactly. It's also plugged. Maybe some growth managers don't want to talk about all this.
Well put. Okay, so I will carry on,
Alan,
and I will
can you hear
describe the charts that you're not getting to see. So when we finally get this to move along, oh, there we go. I got the second chart. So So the next chart was addressing, so let's go back one. Since we've been in an inflationary environment, so we can go forward one, thank you. Excellent. How has value done versus growth? And on the left-hand side is Canada, and on the right-hand side is the international market without the US, because we all know what's happening in the US market. It's the big, broad market. It's 70% of the world index. People pay attention to what's going on there. The Magnificent Seven is really covering over what's happening below the surface. And in these two markets, we have here, the left is Canada, and then international. And the very top line on both, or pretty much the top line, is the value index, and the bottom line in both those charts is the growth index. So value has been outperforming growth significantly, and shockingly, in my opinion, I didn't expect to see this, when you look at the value index versus the growth index and you do quick math, the result is 11% outperformance, just like Professor George Athanasakis calculated. That's kind of, not often you hit it on the head like that overall. So that it is working when you don't have the Magnificent Seven covering up what's happening below the surface. This next slide is showing you what's happening in the US. And you can see that 60% of value stocks in the US are outperforming. So value is working in the US, and only 40% of growth stocks are outperforming. But it's that tail risk, that far right-hand side of the chart where the Magnificent Seven are, and they're making the growth story look like it's winning. So we've got this subset that's doing extremely well. And so the big question is, when does that come down? Because the underlying story is the typical story that's happening in an inflationary environment. So how long should we guess that an inflationary environment will last in the marketplace overall? And we're going back in history here, and you can see that from the far left-hand side, you had the American Civil War, and then after that, inflation comes off after a war is over. And post-war, you tend to get them longer, so it took about 30 years for interest rates and inflation to bottom. And then you go to what I would call the more normal, typical cycle of 20 years. So 20 years of inflation, then 20 years of disinflation. And then after 1941, which was Pearl Harbor, America entered the war, and the next year inflation was 9.5%. And then you entered an inflationary period that lasted a remarkable 40 years. And they tend to be symmetrical, these inflation and disinflation cycles. I wouldn't hold anything to that, but there is this bit of a tendency there. And so then you have, it got followed by a 39.5-year, let's call it a 40-year disinflationary cycle. And so far we've been in a 5.5-year inflationary cycle. And because disinflation was so wonderful for consumers and helped them pay off their debts so nicely, especially heavily indebted American consumers, there's no surprise that the market is wishing to go back to disinflation. But the reality is we haven't seen in history a shorter than 20-year cycle, roughly. So more than likely, we have another 15 years of an inflationary cycle to face. And in particular, this I call a very disturbing chart by Torsten Slok at Apollo. He gives away his daily charts for free, so you can easily access this yourself. And he's comparing and inflation, when you go back historically, it tends to come in waves. And he's lined up the 65 to 82 stagflationary period, which some people are arguing we have entered a stagflationary period. And it's remarkably similar. And you can see we're at a very critical point, as they were back then, where you have to play your cards very carefully not to go into a major inflationary spike. And yet you have an American president similar to Nixon. In 1974, Nixon put pressure on his central banker to drop interest rates because he was facing a re-election. And the central banker did comply and died on his deathbed saying, that was the biggest mistake I ever made in my life. So every central banker knows this history and knows they want to avoid it because runaway inflation is very difficult to suppress overall. So what happened in a stagflationary environment? And so this is the famous 65 to 82 time period. And it ended up being a sideways market where basically the market ended where it began. And you had a lot of volatility in between. And every time the market went down dramatically, you can imagine that would have been great for value managers. We would have picked up a lot of return as the growth guys got killed. And then every time the market went back up, you could have imagined that that would have been really good for a growth manager because that's when their stocks would have done extremely well. And you would think that the end of that time period, that there was a tie between value and growth, but there wasn't. The total return was below historical averages, just under 6%, but the return for value was 13.5% overall. So it was a great opportunity for value to win. And what we've seen so far in this sideways market where you can see value doing well, not being hidden by the Magnificent Seven. And then just showing you, you break down the market into quintiles, and you can see that in that time period, the cheapest quintile, the cheapest stocks, the most value of the value stocks, when you have your best cheap characteristics, that should do really, really well. Then they did do very well. But we suggest you have to be very careful in this environment because there's a number of managers out there that have deeply gone the other way into quality overall. So why don't I believe that's the end of my slide deck and pass it on to the next speaker.